Hi, do you know how to save your losing stock trades using options? Today, SlashTraders will show you how to sell covered calls to hedge against your stocks, so you can earn a premium from selling options to reduce the cost basis of your stocks. We will also share with you a few drawbacks of selling covered calls, so you know when not to trade them. We'll talk about 3 key points today. 1. What is a covered call? 2. Why sell covered calls? 3. 3 reasons why we don't sell covered calls. A covered call is an option strategy that hedges against a long stock position by selling out-of-the-money call to collect a premium if the stock price doesn't rise. Let's review the profit analysis of buying stocks. A long stock position has a 50% chance of profit. We profit when the price rises and lose when the price falls. Selling an out-of-the-money call option collects a premium. If the stock price does not increase past the strike price before expiration, the option contract expires worthless and we keep all the premium. But if the stock price increases past the strike price, the maximum loss can be unlimited. When we combine buying 100 stocks with selling a call option, we get a covered call. The premium received from the short call can reduce the cost of the stocks and increase your chance of profit. If the stock price increases past the call strike before expiration, the 100 stocks will be sold at the strike price for a profit to compensate for the loss of the call trade. So a covered call caps the future upside of the stocks in exchange for the income from selling a call option. If we want to hold on to a stock for the long term, but are afraid of a bearish trend, we can trade the covered call to hedge our position. We can use the Palantir stock as an example. Palantir IPO'd at $9 a year ago and quickly rose to $45 before falling back to the current $25. If we purchased 100 PLTR stocks at $45, we would have a losing position now. So we can trade the covered call to collect income and wait for the stock to rise. A 20 delta short call at $28 that expires next month can receive $49. But if the stock price rises past $28 before expiration, our 100 stocks will be called away at $28 for a loss. If the stock price doesn't rise beyond $28, the call option would expire worthless. Then the cost of our $100 Palantir stocks would be offset by $49 to become $4,451, reducing the cost of each stock to $44.51. The cost per share will continue to drop as you sell successful covered calls. You may notice that if we want to make sure we profit from the trade, we need to sell a covered call at $45 or higher. This way, if the stock price rises past the call strike, we break even from selling the stocks. But we find the $45 short call has only delta of 1, so the premium received is extremely low at $3. Therefore, the trick to trading a covered call is to find a high delta strike price that gives us a good premium without being breached before expiration. Even though the covered call is a key part of the wheel strategy, but there are 3 key reasons that we don't like to trade covered calls. 1. A covered call requires too much capital and has very low returns. 2. Good dividend stocks usually have poor option premiums. 3. Covered calls can miss out on sudden bullish trends of growth stocks. We can see the covered call requires the purchase of 100 stocks, which requires around $2,400 of capital investment, while an ATM bull put spread only requires $51 of buying power. Despite both expiring in 30 days, the maximum return of a covered call is 16%, while the ATM bull put spread has 96% return. Then the annualized return of covered calls is 192%, while the at-the-money put spread's annual return is 1,152%. So there's an opportunity cost of using so much capital to trade covered calls for a low return. Dividend stocks are poor candidates for trading covered calls, since dividend stocks or ETFs have lower IV and therefore receive a lower premium from the call options. For example, trading a covered call for SPY at 20 delta would have a very low strike price, leading to a maximum return of 2.9%. If we try to sell covered calls on a high IV growth stock like Tesla, a 20 delta covered call has a maximum return of 11%. The strike price also gives us around $86 of upside potential, which looks good at first, until we realize that Tesla would experience bullish trends that gained $100 in 30 days. Such price bursts actually happened 3 times in the past year. If we traded covered calls for Tesla in the past year, we would have missed the big gains. Now you know the basics of trading covered calls. You can see despite the low risk trades, the cost of each trade is very high and has low returns, and we can miss out on big price gains on growth stocks. So we don't like trading covered calls here at SlashTraders. If you enjoyed my video about trading options, please like and share my videos and also subscribe to my channel. Thank you.